Informative and unpredictable, testing the limits like only we can. From Span Enterprises in Rock Hill, South Carolina, it's The Bandit Room. And welcome to The Bandit Room. I'm Charles, this is Joel, and we have a special guest in with us today in The Bandit Room. He's a CPA, he's a blogger, he's a food writer, he's a podcaster, and on top of all that, he also is a marathon runner. Just got back from the Berlin.
I would say Renaissance man.
You're a Renaissance man of sorts. Jason Ackerman is his name. He's in the studio with us today. Thanks for joining us.
Thanks for having me. I'm excited to be in the Bandit Room.
Thank you. We appreciate the enthusiasm.
This is the highlight of my year, so.
Good. I hope we live up to it. So we'd like to ask you a little bit about taxes. Could you give us just a broad sense of how taxes work in the United States? We'll just start at the very basics, and we'll start get further from there.
So I think the biggest misconception is we have a tax bracket structure in the U.S. And what that means is when you hit certain income levels, you get taxed at a different tax rate. But what people don't understand is it's a gradual rate. So on your first $15,000, let's say, of income, you're taxed at 10%, and then above that, from 15 to 25, you're taxed at 25%. So it goes up like that. It's not when you hit that bracket, all of your income is taxed at that rate, at the bracket that you're in. It's just the income above that certain amount, if that makes sense. Okay. I think that's the biggest thing. So when you hit the next tax bracket, let's say you hit the 25% bracket, it's not like all of your income is taxed at 25%. It's just your earnings once you hit that bracket and above. I think that's the biggest thing that people miss. So they think, when you hit a large tax bracket, you're getting screwed because all of your income is getting taxed at that level, but it's
sure.
not.
I'm paying 25% in taxes when maybe not exactly.
Yeah.
Really break it down, especially after you.
So like in the current legislation, when they say they're simplifying the tax code by getting fewer brackets, that's not really simplifying the tax code. That's just making it so that it's one less math step. Yeah. But it doesn't really affect your tax rate.
Yeah, it doesn't affect the complexity of it. It's only more of a surface level change.
Exactly.
Interesting. Okay.
So that's the biggest misconception I see when people come in and they just don't understand. And another big thing too is we don't have a tax rate at 100%. So when you make more money, yes, you're going to pay more tax because that income is taxed at a higher rate, but it's not like all of it goes to taxes. Mm-hmm. So when people are they say, I don't want to pay any taxes, so they try to get all these deductions and stuff. You don't want to pay zero taxes because that means you didn't make any money. And if you don't make any money, then you're not doing so well.
That's true.
That's what we always say. If you pay taxes, that means you had a good year. Now we want to minimize the tax that you pay, but you don't want to be at zero for too long. Because if you're zero for too long, then you're going to be bankrupt.
Yeah, that's true. All right. So, from a general perspective, what do you say most Americans, from your experience, what are some overlooked deductions or credits that people might not be taking advantage of in order to kind of minimize that tax bill? Like you said, you want to pay them. But of course, you don't want to pay more than you have to.
Yeah, I'd say the biggest thing that people don't take advantage of are IRAs and your 401k. So if you're employed and your employer offers a 401k or a simple IRA or some sort of retirement plan, they're most likely giving you a match. So the first thing is whatever you contribute, they're going to match a certain amount. That's free money. You should definitely take advantage of that. And I see so many people who don't contribute at all because they think they can't afford it, but then they're just leaving money on the table. And hey, you never want to leave money on the table when it's free. And also, you have to start saving. The earlier the better. If you wait until you're in your late 40s or 50s and you try to save for retirement, you're never going to be able to retire. So my big thing is contribute to your 401k. There's two ways you can contribute. It's either via a traditional, which means you get the deduction now, and then it grows tax-free, and then when you take the money out, you have to pay tax on it. Or you do post-tax, which is you don't get a deduction now, but it grows, and then the investments grow, and then when you take it out, you don't have to pay tax on it.
Gotcha. And so a traditional IRA is tax-deferred.
Correct.
Is that correct?
Yes.
So you're paying taxes on it when you take it out, but you're avoiding those taxes when you...
So you can get a deduction out, and it depends on your tax bracket what one you want to do. So if you're in a really high tax bracket, you want to do the traditional because you'll save more money, because most likely when you retire, you'll be at a lower tax bracket.
Right.
That's kind of the thinking. But that's the biggest thing for employees that I see that they're missing. Another good thing to do is an HSA, so that's a health savings account. And that's if you have a high deductible health plan, and most people's plans are now high deductible, you have to check with your insurance broker or agent or your HR department to see if you qualify for a health savings account. But let's say you do. You can contribute to that, and you get a tax deduction when you put the money in the HSA, and then you use that HSA health savings account for medical expenses. The good thing about HSA, it's not a use it or lose it plan, so it carries forward until you die. So you can use that until you die. So that's another good savings vehicle, especially for younger people. You know, younger people aren't going to the hospital or to the doctor as much, but you can still contribute to that HSA, get the tax deduction, and then leave it in there for when you need it, because eventually in your life you're going to need your HSA to spend.
And typically you can invest in your HSA as well, correct?
Correct.
Or you typically have stock options inside your HSA.
Yeah, so you can definitely invest in your HSA. You have to just go through an HSA provider that allows that. Like I use hsabank.com for that. There's a couple others that allow you to do that too.
Okay.
And if you have an HSA through your employer, which a lot of employers do, it's better to contribute through your paycheck because you don't have to pay Social Security and Medicare tax on your HSA.
Gotcha. And whatever you put into an HSA, is that tax deductible or is that?
Yeah, whatever you put in is tax deductible. So you get a tax deduction straight on the front page of your 1040, which is the individual tax form that you file.
All right, good stuff. Along those lines, you bring up healthcare. One thing I think people aren't fully, most people are aware, but some people may think it's gone, is the Affordable Care Act or Obamacare. It's still technically on the books. So, when people are filing their taxes, they're going to have to show, it's the end of the year now, so it's a little too late, but the ACA requirements to have health insurance throughout the year are still in place. And the penalties from what I've seen are 2.5% of your income or $675 per adult, $347 for children. So it's a big cost to not having health care. Some people are exempt from the ACA, from actually the individual mandate as far as having health insurance throughout the year. But I know it's such a hot topic these days. It seems like it's going to go away, but still technically on the books. So
So people thought when Donald Trump got elected that the ACA would be repealed, and they haven't been able to do that.
Right.
So the individual mandate as of today is still in place. So that means you're required to have health insurance. And the whole reason behind that is, if you don't have health insurance and you have a catastrophic event, like it's going to basically ruin your life. Like you're going to go bankrupt and you're going to spend the rest of your life paying for those medical expenses. So the idea is you need to have medical insurance.
Yep.
And the ACA, if you're a low income, provides for subsidies. So you're not paying that much for that health insurance. And the reason why they made it required was they need to get younger people in the pool. They need the entire population. You don't just want sick people on the insurance plan, because that drives up the insurance cost for everybody.
Right.
So the idea is we'd get everybody in the pool. It'll lower the cost of insurance for everyone. And that's why the individual mandate was put in place. And it's why it's so hard to get rid of, because if you get rid of it, everyone in Congress knows that the insurance marketplaces are going to skyrocket.
That's true.
So, like you said, you have to get insurance or else you're going to pay a penalty. And you can do the cost analysis and see, okay, I'll pay $695 or whatever. But you just got to think, if I get hurt or I get injured, like I'm going to be screwed because I don't have health insurance.
Right.
So just think about that. And normally you get to deduct it from your taxes.
Yeah, and so that'll affect people when they're doing their 2017 return. It's still technically on the books, right now. So, enrollment season.
Enrollment
is still
season's
open
happening
till,
right
December
now.
15th,
December 15th. Yeah.
December 15th. So, you still have time to enroll if you're not currently covered and looking to make sure you are for next year. So.
Yeah, you go to healthcare.gov, and the website's actually not too bad. You go there, answer some questions, and then sign yourself up.
Mm-hmm. Yeah, relative.
And I will say you do have to put the subsidy is calculated by your adjusted gross income for the year. A lot of times you don't know your adjusted gross income because if you're an employee, you might get a raise or a bonus, or if you're self-employed, you could have a good year or a bad year.
Mm-hmm.
So you just kind of have to estimate. And I would always say estimate a little higher because you will have to pay back the subsidy if you make more money than you said you did. So kind of estimate a little higher so that way it's always better for the government to pay you a little more money back at the end of the year than you have to pay the government a lot more.
That's true. Now, as far as tax credits or deductions go, obviously people need to be honest about these kind of things. However, what do you think are some ones that people are finding, or the IRS may find that people often misuse? I've often heard that you don't want to get too liberal with your home office deduction or something like that if you don't actually use it for a business purpose of your own or something, whatever that may be. Are there any other sort of deductions that people often misuse and people should be careful about?
Yeah, a home office is a big one. You never want the IRS during an audit to come to your house.
Mm-hmm.
So, they normally won't, but a home office, if you have a actual office someplace else, you can't have a home office and another office. So if you're doing a home office deduction there, employee business expenses, like if you're working for a company and you try to write off all of these things like your cell phone and your mileage that you're driving, that can be kind of a red flag.
Yeah, especially if you work for a company, if you're not your own business.
Yeah, exactly, because you can't deduct your commuting miles, which means from your house to the office is not a deductible expense.
Right.
So a lot of people think that is, and then you put that you have a bajillion miles and really you're just driving to your office and back, especially if you have a long commute. So you just have to be careful there. When you're self-employed, some things that the IRS doesn't like, deducting 100% of your cell phone. You can definitely take a percentage of the cell phone, but 100% they don't like. Another thing is you're required to send a 1099 if you pay someone, a contractor, $600 or more. And if you don't pay that, or if you don't file the 1099, and you should be using Express IRS to file your 1099s, right?
Of course.
But yeah, if you're not filing that 1099, you can't deduct that expense. That's the first thing the IRS will ask you. Have you filed your 1099s? And if you haven't, then they're going to exclude all of that expense that you tried to deduct.
That's true. And if you need to file that,
I actually have a question for you. Things just saying that.
Yeah.
So my wife has her own business, and she has a virtual assistant, a company that has a virtual assistant. Should she be sending the virtual assistant a 1099, or how does that work?
So the rule is you don't have to send a 1099 if they're incorporated.
Okay.
So that means if they're a corporation or an S corporation. And the way you figure that out is you should send all your contractors a W-9 form. And all a W-9 form is it asks for their name or their business name, their EIN or their social security number, and their address, and what type of entity they are. And when they get back that W-9 and they mark corporation, then I don't have to file a 1099.
Okay, all right.
Yeah.
Good. Something I did not know.
You can do all of these things through taxbandits.com.
That's right.
Tax Bandits, yeah.
Formerly Express IRS.
Sorry, I'm old school.
That's right. You can still use it. It's really this domain's still active. Cool. All right. Any other big tax questions, John?
Like you said about mileage. Obviously you can't write off 100% of your mileage. There's always going to be personal miles on your car.
A great app to use is MileIQ. That's the app I recommend.
Okay.
It's like $5 a month, super cheap, and it's basically like Tinder. You swipe left if it's a business, or you swipe right if it's personal. So, but the IRS for mileage, it's form over substance, which just means they're not going to GPS go to their satellites and look where you drove. You just have to have record of where you drove, and that's what MileIQ does. So it keeps a GPS log of everywhere you go, and it's audit proof for the IRS. So the big thing with mileage is just keep your records, and that's kind of with everything. You need to keep, for your business expenses, you have to keep a copy of the receipt. Like a bank statement normally will not be sufficient, especially if it's a Walmart expense or a generalized expense where it's hard for the IRS to tell exactly what you bought there. So you need to keep a receipt. You don't have to keep a hard copy of your receipts. You can keep a scanned copy, but you need a copy of the receipt. And oftentimes, actually, the actual receipt will disappear in 6 months because it's on the crappy paper. So get like a neat scanner. If you're a small business, the best thing for you to do is get an accounting system. The ones that we recommend are Xero is our preferred one, but there's FreshBooks, there's Wave Accounting, there's QuickBooks Online. Get an accounting system and keep track of your expenses that way. Because if you are unorganized, it's fine until you get audited, and then it's not fine.
It works until it doesn't.
Yeah.
And when it doesn't, that's a problem.
And an audit is an easy experience if you're organized. If you have everything in your accounting system, like it's stress-free. You get to go up. If we're based right outside of Charlotte, so you get up to UNCC and hang out with them for a day, and it's not too bad. But if you're unorganized, it is not a fun experience.
That's good. So what happens if you don't pay taxes?
A giant bald eagle comes and takes you away. So basically what happens is the IRS, so the stuff that your income is getting reported to the IRS some way. So if you get a W-2, your employer's reporting it. If you get 1099s, they're reporting it. So the government's going to file a tax return for you through their computer system, and they'll determine whether you owe tax or not for that year. Oftentimes people who don't file, like they probably would get a refund back, and they just they think they don't need to file or whatever. So they don't do it. I've had that happen a lot. They just think, I don't want to pay taxes, but they have a W-2 and they're withholding taxes and they withheld too much and they would have got a refund. So go figure. But the IRS basically will file a tax return on their end through their computer system, and if they don't jive, which means the IRS thinks you owe money, they're going to send you a letter. And basically, you're not going to go to jail unless it's tens of thousands of dollars, but they'll just go into your bank account and take the money after a certain period of time.
Nice. It's an interesting thing you bring up, because I don't think everybody's fully aware. I mean, whenever you get a 1099 or you get a W-2, that information has already been sent to the IRS. So the IRS has all of everyone's income information as of January of the year. There's talk of file-free taxes or something, where the IRS technically could just do your taxes for you based on that information, send it to you, check it off, make sure.
That's kind of the dream. They actually have that in Australia and the UK. But their tax code is a lot simpler than ours. But the idea is the IRS doesn't have everything because it doesn't have certain things that aren't reported to the IRS.
Right.
Like if you don't get a 1099, you still have to report the income. Just because you don't get a 1099 doesn't mean you don't have to report the income. But you're right. They can do 90% of it, and you can actually look at your transcript. So if you go to the irs.gov and you can pull up your e-transcript and see what they have on you. So we do that a lot with clients. If they're elderly and they're not quite sure, they're losing their memory, we'll get their tax transcript to make sure we're not missing anything. So it's something you guys can do too. It's free. You just can go on. You can also get copies of your tax returns filed. I don't know how far they go back, but they go back pretty far. The other thing too, the IRS can audit you back 3 years. So for the previous 3 years, they can audit you unless you never filed a return or you committed fraud. So the fraud barrier is pretty high. It's hard to commit fraud, but it's easy not to file a tax return. So you want to make sure you file that tax return to start the audit period. Because once you get through 3 years, they can't come back and get you normally.
Sounds good. All right. Let's see. Any particular thoughts on the future of our tax code?
Yeah, I just wanted to kind of bring up, the big thing that's happening right now in Congress is the tax reform.
Cut Act.
Yeah, the cut Act. And, it's taxes serve a purpose for our country, and it's not. The government is needed for certain things. We've decided it's for education, some things should be for healthcare, some not, for defense. There's certain reasons why we need the government to be funded. And it's important that we don't drive up national debt and we pay our bills, and that's what taxes are for. Now, we definitely need a tax overhaul of the system in the country because it is too complex for small businesses. It's not so much the tax rate, it's just the complexity. There's all these loopholes, and it's just hard for a normal person to file a return and know what's happening.
Right.
So we definitely need reform, but what we don't need is a big tax cut for wealthy people, because that just doesn't spur the economy.
Right. No, it's been tried before.
So, and the biggest thing that upsets me about the tax bill that's happening now is getting rid of the estate tax. Because our country is kind of founded on a belief that we don't pass down wealth from generation to generation, because we believe that as Americans, you have a kind of right to do whatever you want, and you shouldn't have an unfair advantage in that.
Right.
And getting rid of the estate tax, which just means right now you don't pay any tax on your estate unless it's over $10 million, a little over 10 million. So if you have an estate under 10 million, which is 99.9% of the country, you get to pass down all of your wealth to your next generation tax-free.
Yeah.
It's only income over that is taxed at the estate rate. So that's for super wealthy people. And that's where we get a bunch of our income that gets used for all of our government expenses.
Right.
So if we get rid of that estate tax, we have to get that income from some other place. And that's going to come from, the middle class and the lower income. So I just think we don't need to be giving a tax break to the super wealthy. We need to give a tax break to the lower income and middle income people, because they're actually going to spend the tax break that they receive, and that's going to spur the economy. Like if I'm wealthy and I don't get a tax cut, or if I get a tax cut, it's just going into the stock market.
Into one of your hundreds of accounts that you
Yeah.
own.
So that's kind of my overview. Like we definitely need some changes in the tax law, but what they're proposing now, I think, has some room for improvement.
Okay. Room for improvement.
Yeah,
Always
there are some good
always
things.
room.
Yeah, there's some good things in
the
there, but
simplification aspects.
yeah, we definitely need simplification. Like you should be able to file it. If you just have a W-2, like you should be able to file that. The government should file it for you. Like you shouldn't have to do anything.
Yeah.
Like you should press it, you should get a check or you should get a bill with what you owe.
And it's almost impossible these days for people to file a return without paying for a tax preparation service these days.
Yeah, you
It's
can't.
almost impossible to do
Yeah,
something.
you have to go. What I recommend, if you just have a W-2, you don't need to come to someone like us for a CPA service, because what we want, we're in the business of providing advice. So when you get to a stage where you need help running your business or you need help tax planning, that's what we're here for.
Yeah.
We're not here to basically do the compliance, which is file the tax return. Like that's a software can do that.
Yeah.
So I would recommend go on TurboTax. TurboTax is great. If you just have a W-2, go on TurboTax. They'll charge you $70, $100. Like that's what you should do. You don't need to go and get a CPA to prepare it for you, because it's just not worth the value for you.
Yeah. All right. So you're turning down business.
I'm not turning down business, but I don't like charging people for stuff they don't need. And I'll tell you that if you come to our office, I'll tell you can do a TurboTax return. You don't need to pay us.
All right.
So yeah, I guess I am turning down business.
In a simplified way.
Yeah.
Okay, to turn it around, you got anything you want to plug, Jason? Obviously, you mentioned the CPA services, things like that, BNA.
Yeah, I will mention that if you're looking for a CPA, you can obviously visit us, bnacpa.com. But more importantly, my wife and I have a food blog, scallypancake.net.
More importantly,
much more importantly.
Whenever you're done filing your taxes.
Like I said, I'm a Renaissance man because I like to eat. So that's really the only thing that qualifies me.
You also like to run.
Yeah.
You like to eat and run.
Yeah, well, I run so I can eat. That's the whole reason.
It's the dine and dash.
But I have, exactly. No, always pay your bills. But yeah, scallypancake.net is our food blog. We would love to afford scallypancake.com, but it's like $2,000 and that's too expensive right now.
Who owns
Somebody owns it. I need tax bandits on that. But yeah, check out our food blog. We actually have a podcast too, which is called Scally and Pancake as well. You can find us on iTunes or Google Play. And I promise you I'll not talk about taxes on that podcast.
So if you like this, don't listen to Scallion Pancake.
If you like me,
if you like Jason,
listen to Scallion
Pancake.
Pancake.
Listen more Jason, listen to Scallion Pancake. Sounds
Yeah.
good. All right. Well, thank you very much.
Thank
for
you.
joining
This
us.
was
Yeah,
fun.
Absolutely.
Yeah. So in addition to Scallion Pancake, check out taxbandits.com if you have any questions about filing a W-2, 1099, ACA forms, sending out W-9s, all these kind of things. Check it out.
They make it easy.
We make it easy. Yeah.
Yeah,
Awesome.
that's what we can.
All right. Well, thanks so much for joining us. We'll see you next week on the Bandit Room.